Have you ever looked up and thought, I'm making more money than I ever have, so why does this feel more complicated instead of more freeing? Welcome back to another episode of the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan, and today we're kicking off a brand new series called Designed to Last, where we break down what it really takes to build a business that can grow, scale, and sustain success through every stage. In this episode, I'm joined by Michael Loki, an advisor here on the Vital Wealth team. And he's flipping the script a little bit by interviewing me. And we're diving into something most entrepreneurs don't expect as they hit higher income levels: financial confusion. Because the truth is, 7 figures doesn't simplify decisions, it multiplies them. More money brings more moving parts, more accounts, more tax thresholds, more complexity. And if you don't build clarity on purpose, the pressure starts to compound. We're going to walk through the real financial framework behind a business that's designed to last. Starting with why profit matters more than top-line revenue, how messy or delayed reporting can quietly sabotage your decision-making, and the simple systems that create confidence, calm, and control. We'll also get into why even profitable business can feel cash tight, how to avoid the house of cards situation that keeps entrepreneurs up at night, and the strategy that helps you stop reacting to your money and start directing it. And you'll want to stick with me all the way to the end because I'm going to connect the dots between these 3 pillars and show you how they're going to work together to help you grow faster with more confidence without burning out, second-guessing every decision, or feeling like something is slipping through the cracks. Now, if you're listening to this and you want the resources from today's episode, I want you to take a simple next step. Head to vitalstrategies.com/cashflow to access the assessment we talk about and start building clarity into your business on purpose. Again, that's vitalstrategies.com/cashflow. And it's the perfect place to start if you want to strengthen your financial foundation and build something designed to last. And before we jump in, if you've been getting value from this podcast, I'd really appreciate it if you take a quick second to leave a review. It helps more entrepreneurs find these conversations, and it lets us keep bringing you episodes that actually move the needle. All right, let's get into it.
Hey everyone, I'm Michael Loki, an advisor here on the Vital Wealth team. If you're waiting for Patrick to jump in, don't worry, he's here. Today, we're talking about something most entrepreneurs don't expect at higher income levels: financial confusion. 7 figures doesn't simplify decisions, it multiplies them. And clarity doesn't show up automatically with success, it has to be built deliberately.
Michael, thank you for joining us here today. It's kind of fun to be on the opposite end of the interview, but I'm looking forward to this. I think this is going to be exciting. We're kicking off a series called Designed to Last, and we're thinking about what does it really take to build a business designed from the ground up and allow it to be successful through all the stages of growth and scaling. So we're going to get started today and start looking at really the financial framework that it takes to build a successful business.
Yeah, awesome. Well, thanks for having me on, Pat. Super excited. But why don't we start here? Why does making more money often feel more complicated instead of more free for entrepreneurs?
Yeah, that's a great question. It's interesting when you think about complexity. If I think about a very simple situation, it's I have $5 and no real income. And the way I solve that is I go start making some income. And when I start making some income and I start saving more money, I'm able to pay my bills. Now my complexity just continues to grow and increase. I have additional questions that begin to pop up, and I start hitting new tax thresholds. I start hitting new entity structure and asset protection thresholds. And so I now have all of these additional problems that I didn't have before. And what went from a simple problem of like make more money now is a very complex problem that also includes make more money, if I want to continue to grow and scale, but all of these other issues that I need to address as well.
So you talk a lot about entrepreneurs feeling tension even as income grows. If we step back, what problem are they actually facing?
Yeah, I think there's a few problems, but when we think about that, we'll say external problem. I've got more money, more accounts, more decisions, and you think about the entrepreneur in general, and the decision making is expensive. My mental energy is, and I've got an interesting story around this. Like, if I go to Subway or a restaurant, I rarely I rarely order. I ask the server what's good, and I just order that. It just takes a decision off my plate that I don't have to spend a brain cycle on. And so I think about that from the entrepreneur's point of view, and it's like, geez, there's all of these things in my external world that I've got to make decisions on, and I've got some complexity without any coordination. I've got to figure it all out, and my financial systems, oftentimes grow accidentally. I start to build this structure that I inherit as the business starts to grow. When we think about things like QuickBooks and my payment processing system, and my bank accounts, and sometimes we've seen clients that have a personal bank account at one bank and a business bank account at another bank, and it creates complexity in their lives that can be frustrating.
Yeah, that makes a ton of sense. And we talk about the external problem there, but my mind shifts to what about the internal problem for the entrepreneur, and what's the internal struggle that entrepreneurs experience as this complexity increases?
Yeah, that's good. And I touched on this a little bit, but we'll call it the mental load of all the decisions that need to be made. That's, I think, maybe the first one. And then there's this thought process of like, man, am I missing something? Is there a problem that I'm not seeing? I'm uncertain about all of these things that are going on out there, and can create some anxiety inside of me that I'm now not just worried about my team and my clients, but I've now got additional financial questions that are out there that I'm concerned about as well.
Well, we as a team here at Vital Wealth work with successful entrepreneurs every single day, and we see their financials up close. We see their P&Ls, we see their balance sheets, in all aspects of their business. From that vantage point, what patterns are you consistently seeing that explain why so many high-income entrepreneurs still feel financially unclear?
Yeah, I think there's a few, and it really breaks down to, the first question is just clarity around like, how much money am I actually making? What is hitting the bottom line? Because I've got money in my bank account, but is that a true reflection? So I think there's a piece of having clear picture into like my profitability. I think that's a good point that a lot of times entrepreneurs are unsure of. They're not sure how much money is going to hit the bottom line. They can forecast and they can have a rough idea, but really getting crystal clear on that is, I think, important. And then it really does become, when we think about what the entrepreneur should be spending their time on, it's their thing they're uniquely qualified to do. I think about our situation in our business, like we should be spending our time focused on solving complex financial problems for entrepreneurs, and there's lots of different problems that pop up, and we want to be the central source for being able to do that. And anytime we're doing things outside of that, like let's just use our example, dealing with HR or, 401k or some other issue that is like distracting us from the main problem at hand. Like we're not driving and generating as much revenue for the organization as we could because we're distracted by those things. So it's like, the entrepreneur should be spending their time and energy focused on the main thing and have people and processes in place to manage the rest of it.
Yeah, that's really good stuff. And I want to transition into kind of like a guide that the entrepreneur can use to build on all these things that we're talking about. So I want to ask, what actually needs to be true for an entrepreneur to build something designed to last?
Yeah. I think the first thing, and I'm gonna hedge this just a little bit, but the first thing is you have to run a profitable business, and that seems to be self-evident. But we can get into other factors. But oftentimes it's interesting to see like a beginning entrepreneur getting really hung up with, my entity structure, and not that those things aren't important, but you don't have a business until you have a profitable business, right? Otherwise, it's just a hobby or it's an expense, and so when we think about, I need to go generate revenue, I've got to manage my expenses to the point where I have actual money hitting the bottom line. And that money hitting the bottom line should also take into consideration my time and energy invested in the business. Because I think there's also a distinction between what we'll call a business and a self-employed, I own a job scenario. And I own a job scenario is actually pretty rough spot to be. And I think that's where most entrepreneurs that start businesses, and the reason why so many fail is where most people live. They're just trying to do more. And then they figure out that, all of the promises of entrepreneurship, like, oh, I'm going to have all the money and all the free time, don't actually exist, especially in the startup phase. You're the last one to get paid. And if anything needs to be done, you're the one that ends up doing it. And so I think there's something to be said about driving profit into the organization. And we've seen some good sized organizations that are very unclear and unsure of how much profit they're driving. And, and that can be okay if there's a clear path to profit. I can invest heavily in my business and have very small profit margins because I'm hiring people, I'm buying equipment, I'm doing things along those lines. But I know once I get to a certain threshold that we're going to have lots of profitability, my margins will stabilize, and I'll be in good shape. But that's something that has to be done intentionally, and you have to know your numbers well. And when I start hearing a client or a prospect or an entrepreneur in general talk about top line, I don't care that much about top line. If you've got $100 million business and 1% hits the bottom line, if you make $1 million off that $100 million business, like, it doesn't take much for that thing to be upside down in a hurry. Versus if I have a $2 million revenue business and a 50% profit margin and $1 million hits the bottom line, I've got all sorts of room there for, the business to wobble a little bit, and I'm not going under, I'm not going bankrupt. So I think those distinctions matter. I would much rather have a high margin, high profit business than something that's operating on super slim margins, because that can go sideways in a hurry.
Yeah, that's great. And I think having a profitable business, that's like pillar number one. It's so important. And one thing I think of, I'm reading a book right now called Simple Numbers by Greg Crabtree. It's a great book, highly recommend so far. But in the book, he talks about owner paying him or herself a reasonable salary. And the reason why that's so important is because underpaying the owner creates fake profitability. And when the owner pays himself below a market compensation, the P&L is overstating profit, and that can cloud the entrepreneur's vision, and it might create a sense of them thinking that they're more profitable than they actually are. And I think finding that out for the first time can be a reality check for the entrepreneur. So that's one thing I think of. How important do you think that is?
Yeah, I think you're hitting on a really important piece, because when there's a few reasons that people build businesses. First is that thing we already discussed. It's like I have free time and healthy cash flow, the money that hits the bottom line. The second is enterprise value. At some point in the future, I can sell this thing for a figure that is that shows that this is a great investment. And I think the thing that happens is, if I'm underpaying myself, I might be a little delusional on what my business is worth. Because if I'm showing large numbers hitting the bottom line, and we'll call that bottom line figure EBITDA, right? And when somebody comes and looks at that, they're generally paying me a multiple of EBITDA, but they're also going to pay really close attention to my financials and go, all right, what is the compensation for everybody in this organization? And if you're a key driver and you're paying yourself $60,000 a year, but to fill that role, it's going to take, $250,000 to put somebody in that spot. And let's just pretend I have a 4 times EBITDA figure, or let's make it 5 times. And I'm going to adjust the numbers. If I'm paying myself $50K and it's going to take $250K to fill that role, I can be deluding myself. I can be delusional by $1 million on the value of my business. And the reason being is, when I add that $200,000 of additional compensation that needs to go in there, that's going to come off the bottom line. and I'm multiplying that times 5x, right? So now I'm mistaken by $1 million on what my business is worth, and that can be frustrating. It can be awfully sobering to the entrepreneur when they're starting to, they spend their money from the transaction on the business, and they're off by $1 million. So I think that is a key thing that you're highlighting that makes a lot of sense. Like we've got to pay ourselves a market rate, or just be realistic as to like, this is going to have a real impact when I go to exit the business.
Yeah, absolutely. Couldn't agree more. And want to transition here and get into why do so many successful entrepreneurs still feel unclear about their numbers?
Yeah. It's so interesting to see the evolution. This year, we've had a couple businesses that have transacted in the $75 to $100 million range. They've taken on either they've sold their business or taken on some minority investor positions to sort of take some chips off the table. And we've been a part of these businesses for years, and we've seen them grow, and we've seen their financial picture and their financial infrastructure grow. And so often we see clients come to us, and we get the whole spectrum. We have clients making $1 million a year that have their entire business run out of a Google sheet. And you're like, how is this even possible? And it's a testament to the entrepreneur that's just like, I will go find a way. And it goes back to my early comment about if we're going to be in business, the number one thing is to go generate profit, right? And that's what they've done. They're like, okay, we're going to go generate profit, and we'll worry about some of these infrastructure things later. Now, once you start generating a profit, we've got to get the infrastructure in place to be able to sustain and grow and scale that profit. And so it really comes down to having just great financial reporting mechanisms in place. And if I had to pick the number one thing that needs to be put in place that is effective way to run your business is a profit and loss statement, and having that done in a software that I can slice and dice the data in ways that helps me see what's actually happening. Personally, I think every entrepreneur should start with a QuickBooks Online account. Now, we've got some clients that have the desktop version that run manufacturing operations that are trying to get out of that desktop version, but because QuickBooks is kind of forcing people to the online version, but they have so many different softwares that are plugged into that desktop version, it's hard to change. But for any new entrepreneur, having QuickBooks Online is like the way to go. It can continue to scale with your organization. Now, we've seen different businesses move to more complex softwares as they've continued to grow, but I think QuickBooks Online is a fantastic place to start. And going back to the profit and loss statement for just a second, we like to break that up into a few different reports. An annual profit and loss is okay, but it really doesn't give me very clear information into my business. We like to look at it on a monthly basis. So we're running it month by month, and then we're comparing it to last year, the same month, and going, okay, let's take a look at a few things. And we like to know, like, are we trending in the right direction or in the wrong direction? And here's how the P&L can help us with that. So if I look at my month over month and I'm trending in the wrong direction, that's a data point, right? If I've got less profit, is it because my business is seasonal and this is just how it always goes? And do I know this because I've run my P&L for this way for a long time and I know these sort of rhythms that my business takes and I plan for those? Or is this just a downturn in I've got some problem organizationally, or there's an economic problem out there that is causing us this scenario? So month to month is the key piece. And then we also like to look at same month last year, so if we're recording this in January, if we look at my January of last year and I'm down month over month, December to January, and then January to January from 25 to 26, like, okay, there might be more problems, right, that are popping up that I need to be aware of. And so the P&L can show us that information. And then the reason we like to see it month to month is I can see some outliers, right? I can see big income spikes or big expenses that show up and go, okay, what is the key issue here that you know I maybe need to go address. And then we also like to acknowledge that cash counting is good. This is, if we think about our bank account, that's good cash accounting, right? The dollars in, dollars out. The problem with cash accounting is it can oftentimes skew how the business is actually performing. So if I pay an insurance premium, that's an annual premium, I should accrue that over the entire year. So there's accrual accounting and there's cash accounting. Most mature businesses move to accrual at some point. Now you can still file your tax return on a cash accounting method versus accrual, and there's a whole discussion there. But when we talk to our M&A consultants that work with businesses that are exiting, if you don't have your accounting set up on accrual, you're going to take a discount. Most mature businesses are set up that way. And so again, it gives you just a clearer picture into your business, especially with things like bonuses and different compensation structures. You can see how those dollars spread out throughout the year versus like seeing these big spikes and dips in your monthly cash flow. So yes, that's a key piece of the framework. Now there's other financial reporting tools that are out there that we think are great. We can think about accounts receivable reports, like how many days outstanding are my accounts receivable, and if that number is long, we should start to put some pieces in place to address that.
Yeah, solid financial reporting is so important, and those are so many good ways to actually put it into practice and take action on all of this. But we've seen it firsthand. People come in with messy reporting, and like you mentioned, some people have all their financials laid out on a Google sheet or a short little Excel document. And I'm wondering if you can explain like how those messy reporting or delayed reporting can affect the decision making of those entrepreneurs.
Yeah, that's good. When you have clear data, an example, I've got a friend that owns a coffee shop, and I live in Iowa, but right on the Mississippi River, and on the other side of the river is Illinois, where we're at. And his coffee shop's in Illinois. We've got two bridges that connect us to the neighboring town, and one of the bridges was shut down, and his coffee shop is close to that bridge. And so he was like, immediately we saw a 30% drop in our margins. Because when we think about margin, right, we've got revenue, then we've got some cost of goods that sit in there. When you're selling coffee, right, like every cup of coffee I sell, I got to pay for the cup and the beans that go into that cup of coffee and the water and the labor to serve it. And then I've got overhead, that just sits there with like my building rent and utilities and some of those other things that are out there. And so he found out really quickly that his margins were dropping. He was down 30%. And so he was like, well, I've got to go fix this. I've got to figure out either how to creatively get my customers that live on the Iowa side that aren't willing to make the, what was now a 3-minute trip, a 15-minute trip, because they got to go find another bridge to get across to get there. I got to figure out how to get my product to them, or I've got to change some things internally. And if you don't have that data, if you can't see that clearly, you're just going to look at your bank account and go, man, what happened? I got less money. And you're going to look at your sales receipts and go, man, we got less people coming in. What should I do about this? So I think there's something too, when I start to see that information, I can go, all right, what are we going to do to fix this and react quickly versus waiting until, a month later, and all of a sudden I'm hemorrhaging cash and I haven't done anything to fix it. So yeah, I think that's a key thing. And then we can also look at, there's just some key, I've been in some peer and mastermind groups around business value. The focus is like, we're going to increase our enterprise value. And one of the ways to do that is looking at gross margin. And here's what gross margin is. It's my revenue minus my cost of goods sold. Okay. So what does it take for me to actually deliver the product, right? And in this scenario, 30% gross margin was like the healthy spot to be. And if businesses were less than that number, if they had 20% gross margin, it was like, okay, we've got to do some things. We got to change our pricing. We've got to figure out our staffing models or delivery models, something. We've got to change something in there. And it's just so interesting to see that, when you start figuring out in your industry that these are the healthy spots to be, and if you can be operating ahead of those, if I can be at 35 or 40% gross margin, I know that my business is going to be more valuable to somebody that's looking to acquire because I'm running a great operation. Now, again, we've seen people that have no clue. They have no clue what their margins are on by anything, and they have all of these things shoved into their P&L that shouldn't be in there. Charitable giving for the organization is fantastic, but it should not be in there. Your tax payments that are going out to for the owner, right, should not be in there. Your payroll tax should be in there. That's an expense for the business, but not the income tax payments and state income tax payments. So I think having clear data just gives you clear picture into the opportunities that are in front of you, because business is dynamic. It's constantly changing, and if we don't have our financial information clearly displayed in front of us, it's a problem. If today's episode is hitting home and you're realizing that making more money doesn't automatically create more clarity, I want to give you a simple next step. Because the truth is, as your income grows, the decisions multiply. Taxes get more complex, cash flow gets tighter, and it becomes way too easy to build a business that looks successful on the outside but feels heavy behind the scenes. That's exactly why we've built a quick assessment to help you identify where your financial infrastructure is strong and where it needs work, so you can stop reacting to your money and start directing it with purpose. You can access it right now at vitalstrategies.com/cashflow. Again, that's vitalstrategies.com/cashflow.
Something that I'm thinking of that is just as important, if not more important than solid financial reporting, and this can be done in the process of cleaning up your books and making sure you have accurate reporting. Can be done simultaneously or after. I'd be curious to hear your take on where this belongs. But thinking about cash management strategy, we've seen it firsthand. Running out of cash in the bank is one of the number one reasons that that business owners go out of business and go bankrupt. So I'm wondering, why does cash still feel so tight for some entrepreneurs, even when the business is profitable?
Yeah, this is a great question. Because we've seen it. We've seen clients that have had $1.5 million, $2 million of profit they're going to pay tax on. And then they start looking at the cash in the bank, the cash that they have access to when it comes time to pay the tax bill. And there's not enough money to pay the tax, and they may have a $500,000, $600,000-$700,000 tax bill, depending on their quarterly payments. And especially if it's a really good year and they were making safe harbor payments, and now they've got 2x the tax bill that they had last year, and they're just not prepared for that. And so the way people get into that situation is twofold. Your accounting method can impact you. So when we talked about cash and accrual, if I'm on an accrual tax filing basis, and I've invoiced somebody, but I haven't collected the income, I'm going to pay tax on that. And so that can work out in our favor. It can also be something we have to be mindful of. Again, we like accrual accounting methods, but I think there's always a discussion with your CPA if we should be filing our taxes that way or not. But so that can be the first thing. If I've got let's say $500,000 of invoices out there that I haven't collected the cash on yet, I'm still going to owe the tax. Now, the goal is to hopefully collect the cash as soon as possible so I can pay the tax. But that's something that can get us in trouble. Another thing we've seen is we've had clients that were growing a healthy business, and we're seeing just year over year, like 50, 75, 100% growth. And it created a tax problem that they were unaware of. They were also a little bit debt averse. And so they had about 700,000 in cash, and they went and bought a building for cash. Well, the problem was they still made $1.5 million of profit, spent some on lifestyle, invested some dollars, and then moved 700K into, this building. Well, the tax bill came due, and it was like, wow, we owe about $500,000 between state and federal, and we don't have the money to pay it. What are we going to do about this? Created some unique tax planning opportunities. We were able to resolve that problem, but that's something to be mindful of. Like, cash management strategy is so important for a successful business. And we've seen very, very complex businesses just continue to refine this process. We helped a client recently put in a 13-week cash flow process, and they just start forecasting out, the next 13 weeks, how is our cash looking week by week? And it's looking at both accounts receivable and accounts payable. So they're going, okay, how much money do I got coming in and how much money do I have going out? And they were a manufacturing organization buying lots of raw materials. And so, they could have $1 million invoices that they needed to pay, and they could have, $1.5 million receivables that they needed to collect on. And so they were finding they were having these dramatic swings. In that example I just gave, you could have $2.5 million. If you pay the invoice of $1 million and you haven't collected your $1.5 million, like, that's a dramatic difference. And we're tapping lines of credit. We're doing things that maybe aren't quite as efficient. Where if we start to create some structure around our cash management with that 13-week cash flow, the thing we like about 13 weeks is it projects us through the end of the quarter, and we can start to see how each of those weeks are going to turn out and how I'm going to end up in the quarter. But the 13 weeks, and that's a rolling 13. So every week I'm looking at, okay, what money am I receiving? Am I expecting to receive? What money then, based on that, should I be paying out in my accounts payable? And so I'm sort of managing the money flow both in and out. And it's so amazing with accounts receivable. That's the money that people owe to you. Like, once you start putting a little bit of infrastructure in place where you're following up with phone calls, emails, what have you, like, people like to pay their bills on time, but life gets in the way, and the squeaky wheel gets the grease. So it's like, okay, I'm going to stay on top of that bill. So we found organizations that just have somebody that's committed to that. It just helps their cash management tremendously by being able to have all the money to do everything from pay payroll to pay their invoices, and not have that stress of like, geez, we've got these $2.5, $3, $4 million swings in our cash flow. That can keep people up at night.
Yeah, that's super interesting stuff. So when I think of kind of what I'll call the pillars that we've talked about, having a profitable business, having solid financial reporting, and having a sound cash management strategy, how do these three kind of tie together and almost reinforce each other?
Yeah. They're so important in relationship to growth and scaling. When I have profit, now I can make intelligent business decisions on how I'm investing in the business. And when I think about that profit piece in my P&L, I can start to see and forecast and plan for these maybe seasonal dips. I can plan for making sure that I've got the liquidity. You brought up a really important point about the number one reason businesses go out of business is they run out of cash. And so it's like, we talk so much about having minimum thresholds of cash on hand, and we just do not go below that threshold. And so, when I start to see these things like, okay, I can marry together my profitability along with my P&L, along with my cash management strategy. It can allow me to make investments in my organization that will allow it to grow farther, faster. And I think there's two schools of thought here that are worth considering. It's like, what do I really want? Do I want to build my business valuation, or do I want to build equity outside of my business? Do I want to build my personal balance sheet? And do I want to take dollars out of the business and sort of redeploy them in, real estate, stock and bond markets, some other investment that I'll say take some risk out of the equation. The reality is, being a business owner with all of my chips in my business, if it goes sideways, I'm losing a lot of my value, versus like there might be some less upside by diversifying into, we'll call it the stock and bond markets, but there might be more safety there. So I think those are key things. And when we start having good systems and processes around all of that, it allows us to make those strategic decisions. Do I want to build my enterprise value, or do I want to build my balance sheet outside of the business? And I can do that in a way that protects both scenarios. So I think that's how these things tie together nicely.
Yeah, that's great. And one thing I'm thinking of is, you mentioned utilizing these and thinking about these things intentionally to grow further faster. So I'm wondering, what is the cost of ignoring one of these for too long, and what kind of effect could that have on the entrepreneur?
Yeah. I've got a friend, a really good friend, and he's not a client, and he's got super messy financial situation. Like it's robbing Peter to pay Paul on a regular basis. And I'm concerned that there's a house of cards that are coming, and it's going to fall down at some point, because there's always this stress around paying vendors, paying, payroll tax, really important things. And I'm concerned that at some point, and the stress has got to be massive, doing that and operating from a reactionary standpoint versus a proactive standpoint. And so I think that the cost in that scenario is like the concern that someday the house will fall down, the cards will all collapse, and there is no money to pay the tax man, because the IRS, state taxing authorities, they don't mess around. They'll come seize your assets. They will lock up your bank account. And now I can't transact anymore. Now that means bankruptcy. And it's like, I think about the work that goes into building a business, and it is a lot of work. To compound that with not having the right infrastructure in place just creates another level of stress that is just not worth it. And it can be embarrassing to be like, man, yeah, I'm running millions of dollars of revenue, but my financials are a mess. To bring somebody into that situation and try to clean it up. But at the end of the day, it's like, it's okay. We've all got things in our businesses that, we're a little bit embarrassed by. Oftentimes it looks like the duck is swimming smoothly across the top of the water, but underneath you see the chaos and the paddling that's taking place. So I think that's something that, if we ignore these things for too long, it's just an added stress, and ultimately, we're missing out on business valuation. We're missing out on cash flow. We're missing out on opportunities to make proactive decisions versus reactive decisions.
Yeah, Patrick, this is good. That about wraps things up. Is there anything else you want to say that is important or would be helpful for the listener?
Yeah, I think there's some key pieces here. Like if this has got your attention, we see entrepreneurs all over the place, and almost everybody, whether you're a new starting business or one that's sitting at millions of dollars of revenue, millions of dollars of profit. There's still work to be done on these, we'll call them financial infrastructure pieces. And so we've created some just a free assessment to get an idea of where you're at. If you go to vitalstrategies.com/cash flow, we'll walk through that assessment with you, and you can look at and go, okay, I see the areas that I need to go shore up. And I would say if you want to take that conversation to the next level, you can visit us at vitalwealth.com and just schedule a time to talk, and we can help you with that. Again, and this goes back to when we think about the most important use of time and energy is staying focused on your unique ability, not getting sucked into accounting work. And so we think bringing sharp people into the equation to help you manage those pieces is an important piece. So it's just know this is a low friction, action oriented assessment that just will help you take action in the right direction. And when we think about what success results from taking action, it's like financial health is designed intentionally. Everything changes when we're healthy. Decisions become clearer, stress lowers, cash starts moving on purpose. Instead of reacting to your money, you begin directing it. And that is when wealth starts to accelerate, instead of just sort of exist as it sort of comes in and out of your bank accounts. And when we think about what happens if we don't do anything, nothing changes. The complexity keeps compounding. As your organization continues to grow, it doesn't get any easier. More income brings more pressure. The financial decisions stay reactive and opportunities are missed. And the business becomes heavier instead of freer. Just becomes this burden on you. So the longer clarity is delayed, the more expensive it becomes. So when we think about this, it just allows us to shift from being, a high earning entrepreneur who, is operating on a hope and a prayer that it all works out, to becoming a disciplined wealth builder who designs outcomes on purpose. Not somebody just chasing strategies, trying to find a new tactic, but someone that's building something that's ultimately designed to last. So the cool thing about all of this is wealth that lasts doesn't happen accidentally. It is designed. And I think that's what we're trying to accomplish with this series here with Design to Last. And we've got 3 other episodes that we're looking forward to putting out into the world to help you as the entrepreneur just develop these frameworks to build something that not only grows and scales, but also gives you just the freedom, the peace of mind to have a successful business and ultimately at the end of the day, live an optimized life. So Michael, I've really appreciated this conversation. This has been a lot of fun. Thank you so much.
Yes, thanks. Thank you so much for inviting me on. I had a lot of fun and I'm looking forward to the rest of the series.
Wonderful. Thank you.
Awesome.
All right, that wraps up today's episode. Thank you so much for tuning in to the Vital Wealth Strategies podcast. I hope this conversation gave you clarity, sparked a few ideas, and helped you start thinking about your financial foundation in a more intentional way. Because the truth is, the more your business grows, the more important it becomes to build systems that keep you profitable, organized, and in control. If you found value in today's episode, I'd encourage you to share it with someone you know who could use this. Another business owner, an entrepreneur, a friend, or someone who's growing fast and starting to feel that financial complexity pile up. And if you haven't already, I'd really appreciate it if you take a quick second, leave a review. It helps more entrepreneurs find the show, and it helps us keep bringing you high-value episodes like this every single week. And if you want the next step from today's conversation, I want you to visit vitalstrategies.com/cashflow. That's where you can take a quick assessment to see where your financial health is at and identify the gaps that may be costing you time, money, or peace of mind. Again, that's vitalstrategies.com/cashflow. It's a simple, low-friction way to get clarity and start taking action. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. And you're vital to me because you're committed to growing your wealth, leading with purpose, and creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you, and I look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives.